Good morning to our wonderful audience and welcome back to Boutiques on Wednesdays. Today we will have a look at SA fixed income and SA equity. In recent weeks, we got another reminder that nothing comes without risk, even in SA multi-asset income funds. Investors reap the rewards of high rates and opportunities still remain, but having a manager that can navigate risks is very important. On the SA equity front, and we've heard it so many times the last year, SA equities look cheap. But is it cheap for a reason? Or can a nimble fund manager still find great investable companies with strong earnings? Or is it a case that South African market recovered while monetary and fiscal policy remains tight? Who knows? We can only time will tell. It is my absolute pleasure to welcome Bronwyn Blood from Granate Asset Management and Charles Guz, Director and Fund Manager at Bateleur Capital. Good morning, Bronwyn. Good morning, Charles. How are you?
Morning, Eugene.
Good morning, Eugene. All good. Thank you very much.
Good stuff. Thank you both for joining us this morning. We're really grateful for your time. Always great to have you with us. Bronwyn, you're going to start and Charles is going to follow straight after you. But maybe just quickly before you start, I mean, over the past couple of weeks, we've seen both Henno Vermaak and Paul Bosman's presentation on Granate's multi-asset capabilities and their philosophy and how great it is to work at Granate. Really great to see you with us. We haven't seen you for a bit. And I think with SA fixed income under the spotlight again, we're looking forward to seeing how you continue to find great returns for investors, but very specifically, how you manage the risks in the Granate BCI multi-income fund. Bronwyn, thank you so much for joining us this morning. You can start when you're ready.
Thanks, Eugene. Okay, good morning, everyone. Thanks so much for joining us today. Yeah, I thought it was a topic of interest at the moment. People are speaking about the risks in income funds a lot. We're getting a lot of questions from investors. So today I'll be talking to you about the three main risks that we think investors face when investing in income funds and how we manage them at Granate, and then what that looks like in a portfolio context overall. So let me start off by saying that we believe that good risk management in an income fund means outperforming the all bond index, but at lower risk. So this chart basically shows our risk-adjusted return over time, measured by the Sharpe ratio on the x-axis and our return on the y-axis. And as you can see, our fund in red against the all bond index in orange, we've managed to outperform the all bond index over 7 years, but at lower risk. The other blue dots on the graph are the competitors, which are also important, but I think to achieve an outperformance of the all bond index at lower risk is what we're aiming to achieve. So what are those risks that we take when investing or when achieving that outperformance? So firstly, in income funds, duration risk is important, which is the level of interest rate risk you take in a fund. Secondly, credit risk, which is essentially default risk or the risk that a counterparty might default in your income fund. And finally, liquidity risk. We aim to achieve liquidity for investors because the whole premise of income funds is that you can get in and out of them when you need to. So the bullet points underneath all these risks sort of go into more detail of what we look at, but I'm not going to take you through that now. I'm just going to take you through a few things that we look at in each of these risks and what that means for our funds at the moment. So firstly, we're looking at duration risk. The most important thing, or one of the most important things, is the steepness of the yield curve. And here what we've shown is the yield curve over time, the 10-year minus the 3-month point on the yield curve. And you can see when it's negative, the yield curve's inverted, and when it's positive, it's steep. So for instance, in the global financial crisis, we had an inverted yield curve. We've recently come out of a period of extreme steepness during COVID, where we had very low short end rates and very high longer end rates. And in an environment where the yield curve is steep, it pays to take duration risk, obviously measured duration risk, but it does pay. So during COVID, we were moving up the duration risk spectrum. We're taking on more interest rate risk into the fund versus now where we're back into a more normal environment. Real yields are high in the front end, and we are reducing that duration risk in the fund. So that's the first thing. The second thing is looking at yield. The yields over time on the government bond curve have increased. As we all know, as fiscal risk has become more prominent in our universe, you can see the 10-year now sort of hovering around, gosh, close to 12%. That doesn't necessarily mean it's cheap. We have models that we look at to determine the fair value of bonds. And these models are sort of based on inputs that go into them, like US Treasury yields, sovereign spreads, and inflation differentials, etc. And you can see at times the red line shows you when the bond market's cheap or expensive versus now when we're in more neutral territory. So that means we're less likely to, or there's less of a need to take on too much duration risk. What does this mean for the fund? It means that our duration profile, as you can see on the left-hand graph, is decreasing. So over, from July 2022, we were at 1.6 in terms of duration. We've come down to 1.2 as a result of all those indicators showing us that there is less value in the market. It also means that we feel like we need a more balanced approach in this environment because we do have very high real yields in the front end. We also look at duration across the curve and the different buckets. Won't go into this in too much depth, but we like the belly of the curve. And as you can see, that's where most of our duration sits, versus linkers where we prefer the short end of the curve. So inflation linkers, we're on the short end of the curve. So this is how that risk translates into the fund. Okay. The second risk that I spoke to is credit quality. And the most important thing for us is that when we look at credit quality at Granate, we separate quality from price. So what this actually means is that when looking at a credit counterparty, we'll consider things such as balance sheet risk, cash flow sustainability, governance, track record of management, etc. If the counterparty does not stack up in terms of any of those things, we do not go any further. In other words, we won't then move on to, oh, well, maybe the price justifies the fact that it's not of good quality. So this basically helps us not be enticed by very, very high credit spreads and then justifying the credit quality as a result. As you can see on the right-hand side, credit spreads have been narrowing in our economy. In 2017, they were around 220 basis points for very high quality investment grade credit versus now at 145 basis points. There is less value in the credit market. And as a result, regardless of whether we deem something to be of quality or not, often when we bid in an auction at a fair value yield, will often not be allocated because the credit spread that it clears at is just too narrow. What does this mean for us in our funds? It means that we've probably got the lowest credit exposure we've had historically. We only have 11% to non-bank and non-govy credit. The red bits on these bars are where our credit exposure sits, and you can see in blue what they are. Anyone can ask me questions on this, but essentially we are very, very comfortable with the credit risk. The biggest sort of area of counterparty risk is the European investment grade credit. In the last bar, which we've been moving into the offshore space as a result of local spreads just not offering value. So that's on the credit side. And then finally, liquidity risk. Liquidity risk is also very important in an income fund. This graph or this chart shows the different credit curves in our economy. And as you move up the yield spectrum, those little stars, as they're going further up, sort of higher up, those entities are likely to be less liquid. So for instance, the lower curve, you get your liquid bank NCDs, but you're only getting a spread of JIBAR plus 100. Then you move up to investment grade local corporate credit, which I've spoken to, JIBAR plus 140. little bit less liquid than bank NCDs, but still there's secondary market liquidity, etc., etc. As we go up to the unlisted opportunities at in excess of 300 basis points, this is where liquidity does become an issue, and you have to manage this in the context of an income fund. So what does that mean overall for our income fund? It means that we look at the liquidity profile in normal conditions and in crisis conditions, and you can see it is very different. During COVID, we experienced it where the bond market was actually illiquid, the government bond market. So that would be a severe crisis condition. But generally, our fund, we are comfortable with the liquidity position. Our fund has 50% in very, very liquid instruments, lots of government bond exposure. And we've classified it in terms of the different timeframes it would take to unwind in normal and crisis conditions. You can see in normal conditions, only sort of 10%, 10 to 12% would be slightly problematic. So we are very, very comfortable with this for an income fund. Okay, and now I have 4 minutes left, so I'm going to take you through what all these risks mean in the context of an overall fund and what the fund looks like. This is what the fund looks like over time. When adding all those risks together and diversifying across the credit universe or across the universe of opportunities, you can see how the different asset classes play into the fund, how we've changed the allocation to those asset classes over time. So, when credit was offering exceptional value and there were a lot of quality credits around because our economy was growing, etc., we had a big weighting to credit. However, now that has decreased to sort of very, very low levels. We've obviously moved into the govie bond space, we've moved into the ILB space, we've increased our structured exposure, and often I get questions on structured exposure. What this is, what this consists of is government bonds with derivative overlays to try and extract the interest rate risk, the duration risk that I spoke about, and then you end up with a floating rate profile. So within each of these exposures, we manage whether it be credit risk, interest rate risk. So for instance, if there's credit risk in a particular exposure, we will spend a long time deciding what the position size of that credit should be in the fund. So something is approved at credit committee, the position size is very important. So it mustn't be too large a portion of the fund. So this enables us to have a very, very diversified income fund, which I think is important. And also I think, having been in the market for so long and understanding all the different areas of value, I think especially now, it's very good to have a balanced approach and utilize all the different asset classes that are available to us. I think if anything, we may be increasing the exposure to investment grade European credit. I think this is where probably the opportunity is, as we're not seeing many opportunities on the local side. This is what our asset allocation looks like in terms of if you take it looking at it a different way. We think the fund is balanced in terms of fixed and floating rate exposure. So we used to have a lot of fixed rate exposure in COVID, which would add to the duration risk. It's become more balanced. The duration is close to 1.2, 1.6, including ILBs, versus in COVID when we're at 2 overall, including ILBs. So we think, given that real yields are very high in the economy, it is tricky because bonds, for instance, have sold off recently, and we will still we'll still harvest those yields across the yield curve as we see value. But we think in general, our fund approach should be more balanced in this environment. And finally, our performance over time, we've managed to outperform since inception very healthily. We target a level of STEFI +2 internally. That STEFI +2 is actually becoming very difficult because of the very high real yields in the economy. So as you can see, we haven't achieved that over the shorter term, but over the long term, that is what we aim to achieve. And our benchmark being STEFI +1, we've managed to achieve that quite nicely. So thank you very much for listening to me. I think the next speaker, Charles, will present now.
Okay, good morning, ladies and gentlemen. Thanks for taking the time to listen to our story. I'm Charles Host from Bateleur Capital. Today, I want to tell you a bit more about our business and specifically focus on the Bateleur BCI SA only, long only equity fund. Bateleur Capital was founded in 2004, originally as a hedge fund management business, with the first fund, a long short fund, launched in 2005. And given our focus on capital preservation in the hedge fund history, we largely manage capital preservation funds, where we apply a consistent investment process across all the funds that we manage. We generally don't like to constrain ourselves to any specific investment style, and we've got a flexible approach to equity selection. I think it's also important that the business is 100% owner managed, with all key individuals, shareholders in the business, and active in the daily running of the business. We're not a large business by AUM, so our smaller size enables us to actively participate across the broad spectrum of opportunities on the JSE. In this slide, we just review some performance numbers. The Bateleur BCI SA Equity Fund has outperformed its benchmark since inception. It's also had a relatively good performance for the last 3 years ending December 23, as we show you on the chart on the left-hand side, on both a relative and an absolute basis. But I think it's also important to look at the chart on the right-hand side, where we compare the 3-year compound annual return for the BCI SA Equity Fund at 16.8% per annum versus the MSCI World at 16% per annum over the last 3 years. And the reason I show you this is really because we get a lot of questions around how we're going to generate returns in a low growth environment in South Africa. And I think these charts sort of speak to opportunities that is available when asset prices are cheap. Now, no presentation will be complete without a domestic economic outlook. So I prepared a bunch of slides on Transnet, Eskom, the SA fiscal position and the likes. But lucky for you, I deleted them all. And I went with a blank page and one quote from Graham Dunford, the Udaco CEO. He came out and said they expect much of the same up to the elections and then much of the same. And we can't agree more. We enter the year, we're already in March, but we entered the year with very low expectations from a macro point of view. But then that begs the question, why are we excited about SA equities and where do we see the opportunities? I think to answer that, I'll take you through our investment process briefly to try and highlight what we look for in companies when we make an investment. Now, I won't go through all the detail, but in essence, we ask ourselves 4 key questions when we analyze a company. So firstly, does the business exhibit a history of above average profitability? Secondly, we try and figure out why that company can show above average profitability and why would it continue to show above average profitability. We want to know who's the stakeholders involved in the business and try and identify the risks associated with it. And lastly, we look at valuation from both a relative and an absolute point of view. Now, this process generally favors companies of higher quality. So those with strong cash flows, defensive business models, growing earnings and dividend profiles, relatively low capital expenditure, and high cash flow generation. Now, the problem is generally when you look at companies through this view, you find lofty valuations when you get to the good companies. What we're currently seeing is that very good businesses can be acquired at very attractive valuations. And that's what gets us excited about SA equities on a stock-specific bottom-up point of view, when we look at our investment process and the businesses that we can acquire. I thought I'll share a couple of examples. I've largely sort of split them in these 4 categories. Companies that can gain market share, companies that's been good at expanding internationally from an SA base, highly cash generative businesses, and some stock-specific opportunities that I will discuss today. Now, firstly, let's look at Shoprite versus Pick n Pay. In previous presentations, I gave a detailed view of our analysis of Shoprite versus Pick n Pay from an operational and capital expenditure point of view. This is largely played out, and just recently, Pick n Pay announced a potential rights issue of up to 4 billion rand, as well as a potential sell down of their key asset, Boxer. We can see in the chart how Shoprite's uninterrupted market share gains has decimated Pick n Pay. We expect this trend to continue. So why is this slide important? It's there to serve to show you how a business can grow in a low growth environment. There's always market share to be gained. So even though the environment might be tight, your better companies, as identified through our 4-quadrant approach, will ultimately perform better relative to their peers. I think the next example is quite interesting also. So Bidcorp is now an internationally diversified food services business, but it's got its origins in South Africa. It was spun out of Bidvest in 2016, but Bidvest themselves entered food services 34 years ago. Bidcorp has now got a globally diversified business operating in Australia, New Zealand, the UK, many European countries and emerging markets. It also has a very impressive track record of growing earnings at approximately 15% per year. In the slide on the right-hand side, we can see that Bidvest is now following a similar playbook to what they did with Bidcorp with their international services businesses. International services now make up 25% of its trading profit. And again, we won't be surprised to see international services separately listed on the JSE or other international markets when that business eventually achieves scale. So again, why is this slide important? It serves to show you that companies can internationalize their operations and grow inorganically and organically in developed and emerging markets outside of South Africa, and also to highlight new investment opportunities that's being cultivated on the JSE, for instance, Services International in Bidvest that will be available at some point of time. AVI is a very interesting business. It's a branded FMCG business. Some of the well-known brands that you would know would be the likes of Rooibos Tea, Alice Brown Coffee Creamer, Baker's Biscuits, to name a few. What makes this company special is its ability to continuously generate very high levels of free cash flow after they've invested in their operations, while they continue to grow earnings and dividends for shareholders. Because of its very high levels of cash generation, it's been able to pay out 95% of headline earnings as dividends since 2005. It's a really exceptional number that to quote. And just over the last 10 years, a shareholder will receive 50% of the current market cap back in dividends as an investor in AVI. So we think this is a fantastic business that will continue to generate high levels of shareholder returns into the future. Keeping with the theme of cash is king, we look at AB InBev. This is a business that generally faced headwinds a couple of years ago that's now turning to tailwinds. Now, AB InBev's acquisition of SAB Miller in 2016 introduced significant debt on the balance sheet. Generally, our investment process don't favor companies with high levels of debt, which means at that stage we did not invest in the business. However, given that the business is highly cash generative, they've been able to reduce net debt by 41 billion rand or $41 billion since 2016, and the balance sheet is now largely being de-risked. We expect this debt headwind to turn into a tailwind in the future years as earnings and dividends will be supported by lower finance charges with the potential for higher dividend growth and earnings growth in the medium term. An additional tailwind that's emerging is the roll-off of the significant cost push inflation that we've seen post-COVID. AB InBev was not able to pass on all these prices to its customers, but with the roll of the cost push inflation, we expect margins to expand in the medium term. So another interesting example of a highly cash generative business that's faced headwinds that's now turning to tailwinds in supportive of the investment case. There's also some very stock specific opportunities. In this slide, we highlight AECI as a company that can refocus itself. Now, importantly, AECI has got a growing global explosive business. It's a large contributor to the earnings in excess of 50%. But at a recent Capital Markets Day in November 23, the new management team announced their new strategic priorities, which is largely centered around focusing the business to its core competencies, being explosives, and reducing loss-making activities in some of the subsidiaries. On the chart on the right hand, we can see that management targets a near doubling of earnings to 2026, which is not captured in the current share price and presents significant upside for shareholders in the medium term. Remgro is another stock-specific opportunity, currently trading at approximately 39% discount to net asset value. That means for every 61 cents that you spend acquiring Remgro shares, you get 100 cents in value. Now, Remgro's got a capital allocation opportunity. It's got significant cash on the balance sheet, but more importantly, large listed liquid investments in the likes of FirstRand, Momentum Metropolitan, and Discovery Holdings that can either be unbundled or sold to acquire their own shares. We've been engaging management to prioritize capital allocation in a more shareholder-friendly way. And should they do this, we expect good returns for shareholders when that's finished. There's also a number of well-managed, high-quality mid-cap companies on the JSE that, in our opinion, is under-researched, under-owned, and undervalued. In the blue bars at the top, we can see how some of these companies are producing record earnings, the likes of Nudeco and Adcock at their recent financial results. However, the red bars at the bottom show you how valuation multiples has continued to contract. We see these as attractive opportunities from a mergers and arbitrage opportunity, as it's highly likely that some of these companies will be taken out in an environment where they perform well, but valuation multiples remain low. This sort of gets me to my last point. Can your manager access these opportunities? In this slide, we broke down the JSE Cap Swix constituents on the left-hand side. You can see that Rand hedge in dual-listed companies, gold and PGM miners, and companies exposed to China and resources makes up around about 50% of the JSE Cap Swix constituents. These are obviously companies exposed to highly volatile and difficult to predict drivers like the Rand, precious metal prices, and the prospects of China. However, I want to draw your attention to the red block at the bottom, the 24%, which we would deem to be SA Inc. I've listed a couple of the household names on the right-hand side, and we ran a simple exercise to say, how does a 10 billion Rand fund acquire a 3% position in one of these companies, assuming they trade 10% of the daily average volume? And you can see the number of days on the right-hand column it will take a large fund to acquire positions in these names. It's highly unlikely that they'll be able to acquire a meaningful stake without having a material impact on the share price of these companies. So that's an area where we see lots of opportunity and our ability to access the opportunity set. So in closing, Bateleur BCI SA Equity Fund is a long track record of outperformance. We've got a deep knowledge of the SA equity opportunity set. We're not a large business, which means we are nimble and flexible and can move quickly to change positioning. And we run a high conviction portfolio of less than 30 positions. So thank you for listening to the story. And we remain encouraged by the wide opportunity set available and see numerous opportunities to still deploy capital in the SA equity environment. Thank you very much.
Charles, thank you very much for that. And while I've got you on, I think from questions, I'm going to start with you very quickly. In your introduction, in terms of Bateleur, what the company is structured like, very strong hedge fund background. That's where you started. So there's a very strong focus on risk management as well. And you mentioned capital preservation. In an SA equity only fund, I mean, how do you manage risk, or even as far as to go to say capital preservation?
Yes, I mean, I think that is very different to the other mandates that we manage. So what we've found over the years, and we've had to ask the question a lot of times, why is the risk lower in our funds where we've got more flexibility? And we found that our investment process actually eliminates quite a bit of risk. So when we are generally attracted to companies with higher cash flows, more sustainable business models, more predictable earnings, less likely to potentially run into trouble or lower levels of debt, a lot of that mitigates our, well, not mitigates our risk, but certainly addresses some of the risks. So generally, we don't favor highly cyclical companies, highly leveraged companies, or turnaround scenarios. And I think that's largely what we can do in a fully invested SA equity mandate. And that's worked well for us in mandates where we have the flexibility, plus obviously the ability to to move around our net exposure. So from a risk point of view, it's really around the stock selection and trying to avoid those riskier parts of the market.
How important is size of fund? I mean, you showed a slide on there in terms of being able or need to be nimble in the SA space. But how important is size in a fund to be able to mitigate some of those risks?
Yes, I do think sometimes it does give you the opportunity to get out or in a position where you want to move quickly. So I do think that it does give you the opportunity. So let's say if you have a 3 billion rand fund versus a 30 billion rand fund, I mean, that's a significant difference. Liquidity has been poor on the market, especially year to date. Now, generally, I think the 4 preceding years, we've pretty much been trading about 22 billion rand per day on the market. Year to date, we're running at 15 billion. So I think it's definitely an advantage to have a smaller asset base at the moment. And that obviously doesn't mean that we turn the fund a lot, but we do have the ability to have a meaningful stake in smaller companies. Smaller companies don't make out a large portion of the fund. We don't run a small cap fund. It's around 15% of the allocation we would think is mid and small cap companies in the fund. But it does give us the flexibility to participate there in a meaningful way and still be able to have liquidity there. Where a very large fund with a meaningful stake in a mid or small cap company, they've got no liquidity to actually move around.
Thanks, Sean. And sticking to that, I mean, from any SA investor perspective, if we look at our economy, it doesn't really feel very good to allocate to SA equity. And if you look at the IMF's expectations of SA's GDP growth over the next couple of years, we end up in the bottom 10% of all countries, which is not great news, and it doesn't look good. But I mean, that said, is it then not an opportunity for SA equity? Because it seems like all the bad news that's possibly out there is already priced in. Is it priced in?
Look, I mean, Eugene, we definitely have enough bad news. That's the one thing that we've got plenty of.
Yes.
We also run global equities. So I don't think, the message that we're trying to put out there is not that we're saying all your money should be in South Africa. What we're saying is don't ignore it. There is very good companies, as I've tried to highlight in previous presentations also, that will generate good returns, in our opinion, over time. We think returns in SA will be lumpy. It will be something like 2021, where you suddenly get a 30% year and then you grind sideways for a couple of years and then you get a good return again. So I think that we need to bring into consideration that we've got very low expectations from a top-down point of view. It's the bottom-up analysis that gets us excited. So, we see the SA equity fund really as a building block, as part of a bigger portfolio where you, as the ultimate client, still have a reasonable allocation offshore and to different asset classes.
Bronwyn, I'm not forgetting about you. There's a lot of questions coming in for you as well. But Charles, while we're on the go, question from the audience as well. Recent headlines from competing managers have inferred to SA as a value trap. Your views on that?
Yes, I think it is important. You can have a scenario where it's a value trap. The biggest risk that we've got here is probably that nothing changes. Then you will be in a value trap. If there is no form of reform, if there's no tinkle of better growth going forward, you can potentially find yourself in a value trap. So we've got to be very cognizant of try and be in companies that will still be able to grow their earnings, even that you're in a very tough environment. Because if you get the growth in the operational and financial performance, we think there is still opportunity to generate returns. I would also just say that, we've had a very tough time here, and tough times don't always last forever. And we've had a great time in offshore markets since 2010 with one little hiccup around COVID. So not that we're advocating again that all your money should be in South Africa. I think the message is much more, don't ignore it, because there is still very good opportunities. With that in mind, there's also much broader investment opportunity set offshore and companies that can be accessed. So again, we would would rather guide you towards a balanced approach where the SA allocation should be very stock specific, but offshore would still play a big role.
Thank you for that, Charles. Bronwyn, like I said, a couple of questions coming in for you. If I can maybe start with your asset allocation, and it is something you didn't really touch on, but it did pop up 4% to property. And I know in some of the other Granate mandates, you've got very strong views on SA as well as global property. Do you think that there's still space for property in a SA income fund? We've seen lots of property and income funds many, many years ago, and then it disappeared. Your allocation at the moment looks like 4%. Do you think it adds value, or does it just add more risk?
Yeah, Eugene, it's a very good question. We've had a lot of debate around this topic. I think we've come to the conclusion that, across our investment philosophy and process, that property is extremely cheap, and not the sector as a whole, but only certain stocks. And we've reflected the view that has gone into our balanced and flexible funds in the income fund, but much smaller position sizing. So for instance, our balanced and flex funds have, up to 15% in property. We'll have 4%, and we'll diversify, where one counterparty or one exposure will not be more than 1%. So that limits or allows that property exposure to be less volatile. I won't go into all the reasons why we think they're cheap at the moment, but for instance, property stocks that go into income funds should have high dividend yields, for instance, and the ones that we're buying because they're very cheap, so more from an equity perspective where the discount to NAV is excessive, and we're hoping for a re-rating, that would be an even lower weighted. So we do think about it in the context of an income fund.
One thing that also interests me is you mentioned that you are starting to look at European credit, seeing value out there. If you were to including European credit, how do you deal with the currency volatility?
So everything that goes into the fund is hedged. We don't have any currency. We've got, we've done sort of analysis on whether it adds value to an income fund, whether adding currency adds value. And for definite, it doesn't. It is a low risk fund, and adding currency just increases volatility. So everything that we invest in, we invest for a yield enhancement, not for any currency view. So any European credit would be hedged.
Thanks for that. Another question from the audience, Bronwyn. Yes, and we get this a lot from clients, investors out there. And it speaks to retail saving bonds. We know there's retail bonds out there offering very high yields. What would you tell investors? Why go into an income fund and not retail saving bonds?
Yeah, I think retail savings bonds have their place. They're just very inflexible. So once you're in, you're in. You can either choose to receive an income, or you can choose to reinvest that income. But there's not much else you can do. You're stuck in it for 5 years or whatever your investment term is. Whereas income funds do offer that flexibility. And I suppose there could be debate around that, given that, there could be debate in terms of the actual liquidity of income funds. But I think generally, that's why we included that liquidity risk, that there is that liquidity risk you're taking on. And then most times, it's easy to get in and out of these income funds. And so I think that's the sort of attractiveness, is that it does give you a yield, similar or better than the all bond index over time, and gives you that flexibility as well.
Staying on SA government bonds, or should I rather say fixed rate notes, when we haven't really seen any kind of green shoots with regards to capital gains on bonds. The past couple of years, it was just rates. So you got your yield, but from a capital point of view, there were losses. Your views over the next 12 to 18 months, expecting a rate cutting cycle, do you think we can see some greens on the capital side of SA bonds?
Yeah, I mean, I do think so. I think that bonds are offering value. You know, I said in our presentation that, you know, we've been tilting the fund more to the short end, and I think that's more just because we think that a balanced approach is appropriate. But I'm not saying that I don't think bonds are offering value, particularly sort of out to 2035, 2030 to 2035. Very, very good value. I mean, the 2035 government bond was offering 11.75% around there, which, you know, for a 10-year bond, it's very attractive. You're likely to, you know, to receive that or slightly better over the next, you know, year or two. There's obviously sort of tail risks on the horizon in terms of election risks, etc. But I think there is a significant amount of fiscal risk priced into the bonds. And therefore, I would feel comfortable having a relatively, you know, not as high as during COVID, because that was the only alternative. But I do think that government bonds are a good option for income funds. But measured risk, so you can't sort of be all in very high duration. I would say that there's also a lot of opportunity on the short end because of where real yields are. So, yeah, I don't think that there's no value. I think that we are going to see a slight re-rating if there are interest rate cuts, which we are expecting towards the second half of the year. But nothing significant. You know, we have to see structural reform and structural changes and growth, etc., before we see massive re-rating in our bonds. So I would expect a slight re-rating.
Definitely not a no-brainer in gunning for bonds at the moment. Bronwyn, again, a question from the audience. I mean, you did present your fund holdings, very well-rounded fund. You're covering a lot of aspects, I think, with regards to instruments that generates yield, including things like European credit. We spoke about that. But a question from the audience, I mean, in the SA multi-asset fixed income space, yeah, we are spoiled for choice. Why Granate? What is your performance signature, and what should clients look for in considering your fund?
I think
this is the time to sell yourself, Bronwyn.
Yeah, so I think we've been in the market for a very long time. We're a team that have been together for a very, very long time. So, you know, we're a stable, happy team. And I think what we've learned is that in asset management, that is absolutely crucial to have that consistency of the people in your organization. We spend a lot of time at Granate developing our culture. I've spoken to this before, but that's one thing. So there's the people element. And then I think over time, having managed income funds since, 2005, we understand what investors are looking for. We understand that they're looking for those consistent returns. We have made mistakes, but we've learned from those mistakes. And I think it sort of shows that in the diversification of the fund and in utilizing all the opportunities that are available to us, because we've been in the market for so long, we know what's available. We don't just stick to one asset class. Putting that all together, I think, we have a very good proposition in the income space. So, yeah, I would say.
I think, Bronwyn, you've made an extremely strong case already. And I mean, I always say the proof is in the pudding. It's in the numbers. Very high levels of consistency. So it's all there. Charles, maybe on a more global macro view, but it does speak to what one can expect from, global equities rippling through into SA equity as well. We've seen a slight uptick on US inflation numbers. We've seen that inflation is a bit more stickier than what people might have hoped for. You're certainly not going to see that same tempo of inflation rates dropping as what we've seen in the past 8 months. It's a base case argument as well. But if we reach a level where inflation, almost reached a plateau and not really coming down as hard as fast as one would hope for, and they push rate cuts out even further. What is your views on potential impact on global markets and more so SA equity? Because I mean, if central banks globally can't cut, if the Fed can't cut and they push it out, I mean, surely the SARB can't cut. And we're already on a slippery slope with SA almost in a recession. You know, so if the SARB can't cut, what do you think is going to happen with global equities and SA equity?
Yeah, Eugene, I think that might be a presentation all on its own.
Yes,
but
definitely.
Yes. Look, I mean, so obviously the scenario we've got in the US at the moment is that you've got a very strong economy and high rates and sticky inflation. Now, should that very strong economy sort of fade away, I think that's where you'll see downside sort of surprises in the inflation. However, that's not what's happening at the moment. You know, the labor market remains very strong. Fiscal spending remains very strong. So it's still, by all indications, a very robust economy, and you know, not even talking about the very low levels of unemployment. So we think it's still a very strong environment there that will probably result in a rate path lower that's more resembling of what the Fed is talking about versus what the market's pricing in. So the market's being a bit more aggressive on rate cuts versus what the Fed is guiding. With that, I mean, from an inflation point of view, the potential risk is oil, in our opinion. You know, the oil price has been fairly stable for the last year at $80. It hasn't really moved. You know, oil price at $100, suddenly you've got inflationary pressure back in. So what's keeping inflation up there still largely is really around the services inflation, and it's rental inflation that's been very sticky, and you continue to see high levels of home prices and shortages of homes. So that will probably still play out this year, but that's now got to that very high base. So again, probably comping easier basis. So, you know, in our opinion, it's really a matter of, you know, where are rates and where are inflation? Now, you know, rates are currently at 4.5 on the 2 years, and inflation is, whether it's 3.1 or 3.2 or 2.9, it doesn't really matter that much to us. You know, there's a real yield there, which we haven't seen in the last 10 or maybe even more years in the US. So for us, you know, rates should come lower. The pace, we're never sure of when and how that happens, but lower rates is good for the consumer. It's good for asset prices. It's generally favorable for the economy. And to your question, how does that play out in SA? I mean, I think we've seen over the last many years that the Reserve Bank is very conservative in respect of monetary policy. We sometimes too conservative, and we would expect them to remain conservative. So I don't think they'll move ahead of the Fed, and I think they won't be moving more aggressive than the Fed either. So even though that will give us some sort of support from a consumer point of view, I do think they'll be slower than what we expect probably too. So yeah, I think that's, you know, generally sort of the view for us. You know, whether inflation beats or missed by 0.1% is not that important to us. It's more the trend. I think, you know, inflation is moderating. We are at 3%. We were at, I think, 9% at one stage. You know, in the US, so, you know, if the 3 becomes 3.2 or 2.8, it's not that important to us.
Definitely cuts on the horizon, but I'm not going to set my clock on exactly when.
No.
Charles, maybe last question. The clock is a little bit against us as well. A couple of open questions, and this partly speaks to one of the questions from the audience, being an SA equity only fund, you know, and in terms of how you think of allocating to SA equity, a lot of general equity funds out there gives you a bit of global exposure. So I do view this fund as a bit more of a building block for anybody that wants to get more explicit SA equity exposure, whether you're an asset aggregator or not. You do run flexible mandates as well. And I think, if I remember correctly, in your flexible mandate, you're sitting on about 38% SA equity exposure, which is quite healthy. But what is your thinking going forward in allocating to SA equity in a flexible mandate? You know, will something like that increase, decrease? Where do you see this going?
Yeah, so I mean, so let's maybe answer that question in the reverse. You know, where are we on offshore? You know, so we pretty much call it 35% offshore plus 5% offshore bonds. So we're not fully allocated to the 45% offshore, and probably yet to, that it's probably where you are moving in time. And then there's pretty much 20% in SA bonds and SA cash, and then you've got 40% in SA equities. So obviously in the flexible fund, you've got the opportunity to be much more stock specific than in the SA equity mandate. So what we would hold in SA equity in the flexible fund is very much stock specific opportunities that we identify on the JSE. And also within that 40% in SA equity, about half of that 40% has got some element of rand hedge earnings attached to it. So I would imagine that in time, our flexible mandate will move towards the 45% limit. And depending on where bonds are at that particular stage, that will influence how much SA equity exposure you have. If the bonds are not attractive in the local market, or cash is not attractive in the local market, equities might be much more attractive. So I think that will play out. But it's quite the 45% allocation when it's filled up, with another 50% in SA assets, call it. It does give you the opportunity to be very stock specific and still have a broad number of shares. You can have 20 odd shares at 2% each and 40% SA equity in the flexible fund. So it gives you opportunity to still diversify and still have numerous stock specific opportunities.
Sean, thanks for that very last question. And it's a bit of an optimistic question, and I like questions like this. So from the audience, say, but if they had in their toolbox, Charles, only your SA equity fund, and Bronwyn, only your income fund, and Charles, maybe a more question from you because you run flexible funds as well. What would the optimal blend be between the funds from a risk-adjusted return position? That's a tough one, isn't it?
Absolutely.
Charles, you're gonna favor your fund. You're gonna say 70-30.
Yeah, I would say if we look at over time, equities have given you a higher return, than fixed income. So I'm obviously got my equity hat on. So I would say a much larger allocation to equities than fixed income, and Bronwyn will probably argue the opposite. So let's see.
No, I think that's reasonable. I mean, I think I'd follow the approach of our balanced fund, which is very similar to what Charles just said. But then you have to have a long time horizon. So you have to be looking over a longer term, versus if you've got a short time horizon and you're going to get 10% from an income fund, let's say 3 years, then it's a sure thing to have a higher allocation to income. But I do agree with Charles. I think equities are expected to return more over long term.
You handled that question very well, because there's so many variables to that are going into play. Exactly what you said there at the end, Bronwyn. Maybe one last point, Bronwyn. I think your running yield at the moment is sitting at about 10.3, 10.2. Correct me. So that gives you inflation plus 4. So if you have a client, shorter term investment horizon, obviously a lower risk tolerance. I mean, if you can get inflation plus 4 from a well-rounded income fund, then why not?
Absolutely.
Yeah. Bronwyn and Charles, thank you so much for your time this morning. It's absolutely great to have you on these sessions, and thank you for the discussion. And to our audience out there, we really appreciate you, and thank you for your continued support. A couple of really great questions. There's some open questions. We'll circulate it through and get the answers for you as well. Quick reminder, next week, Wednesday, the 30th of March, we are continuing our discussions on SA fixed income and SA equity with Aluwani on fixed income and 361 on SA equity. Very topical at the moment. Charles and Bronwyn, thank you so much again. It's been really great having you on the session today, and thank you for the discussions as well.
Thank you very much.
Thank you very much, Eugene.